Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Welcome to the NREI Weekender with your host, David Bodamer. Let's dive into this week's top news. Good afternoon, David. How are you?
I'm doing all right. How are you today?
I'm doing fine. No pressure, David, but I get all my news from you. So what have you got for me?
There's a bit of a theme in three of the stories from this week, which all relate to the concept of sharing space. So
back to the sharing space thing.
Yeah.
Okay.
So we had a story about co-living. So that's on the apartment side, something about how retailers are sharing space in malls, and then co-working, which is sort of like the thing that got us kicked off. And in addition to that, what I actually want to start with was a new report that came out on an update on the most expensive office markets in the world.
All right. I'm thinking it's got to be New York, Seattle, LA, in the States, and then someplace else, right? I mean, what's the big city outside?
So this is data from CBRE, and this is an annual report they do looking at like the average occupancy costs in the very top markets. Mm-hmm. And the most expensive market is actually a sub-market in Hong Kong, which is actually even more expensive than anything in the United States.
Yeah.
So Hong Kong Central, one of the sub-markets, has an average occupancy cost of $322 per square foot. Which is actually almost $100 per square foot more even than the second most expensive market in the world, which is London.
Wow.
And then some of the others, and then there's, in terms of the overall like top 25, a good percentage of them are actually based in Asia. So there are there's another submarket in Hong Kong that's in the top 5, a couple submarkets in Beijing, Tokyo, Shanghai. So a lot of actually places in China, in addition to Tokyo, Seoul, also show up. For the United States, yes, you're right. New York is which is also split into submarkets. All three of the major submarkets in New York are among the top 25 most expensive. So that's Midtown South, and Downtown. And generally, overall, what the report found as well, in addition to sort of ranking the markets, is that occupancy costs overall rose about a little bit over 3.5% pretty much every year, everywhere on a year-over-year comparison. So these costs are rising pretty much the same pace everywhere around the world.
Wow. Well, I mean, that's good news in one way and really bad news in another, right?
Right. Yeah. It's good news for, if you're an office landlord, obviously. Yeah. Well, yeah. I mean, if that's primarily rents, then yeah, it's good news for the landlords. I think they factor in other factors into. I think it's also affected by exchange rates and some other things.
Gotcha. Okay.
So some levels it might not even be a straight gain to the landlord, but in most cases, I think it probably is. But yeah, on the flip side, yeah, as an occupier, higher occupancy costs is that hits your bottom line.
Well, I mean, at over $300 a square foot compared to the rent on my first apartment, I basically get 2 square feet to live in.
Exactly.
Right? I mean, it's going to be really tight quarters. So, all right.
Yeah, and in most of the top 25, you're looking at over $100 per square foot. Once you get to the lower reaches of the top 25, it is where it gets.
Yeah, once you're slumming it, right? Get out of here.
Yeah, you're only paying $95.
Oh, what a bargain! What a bargain! Sign me up. Jeez.
Yeah.
All right. What else do we need to talk about within that story itself? Anything that really jumps out at people?
There were a couple of markets where costs went up fairly dramatically. They also broke out a ranking of the markets that had the fastest year-over-year increases. And we're comparing first quarter of 2019 to the first quarter of 2018. So some of the markets that had the largest jumps included Porto, Portugal, where actually costs are up 24.7%.
Wow. Man, that's a huge jump.
Yeah. Yeah. And then Cape Town, South Africa, 20%. Singapore is up 17%. Budapest, 15.5%. And then Palma de Mallorca in Spain is 14%.
Okay. So quick question. Maybe it's in there. Maybe it's not. Now, I say huge percent. I mean, that's a huge jump for Porto. I think you said Porto, Portugal. But at the same time, if it was $2 a square foot and then it went up to, $2.38 a square foot or $2.50, that's a different story than, $50 to $75 or $100 to $150. Did they say what the cost in Portugal was, or did they just have that percentage of growth?
They do. I don't have that number in front of me, but it is in the report. The report breaks down all of they're looking at, I think, over 100 different markets. And then in the report itself has the data for all of them.
Gotcha.
I think 122 markets actually. So if you look at, you'll see what the actual numbers are. I think of those markets, the ones that are, I think Singapore is probably the most expensive. So it was pretty expensive. It's a pretty expensive market. And then it had a fairly
large jump like that. Yeah.
Large increase.
Yeah. All right. What's the next story we're covering today?
So now we're going to go into our trio of new economy stories.
Hippie commune stories. Sorry. Co-living stuff.
That are all about how, sharing of space is affecting different sectors. So the first one is a look at the spread of co-living as a concept that is coming to various cities, and how both traditional apartment owners and then, interestingly, developers that have specialized in the past on student housing are now getting into operating co-living spaces, because it's a very similar business model to operating a student, a for-profit student housing building.
Gotcha.
So, and actually one of the people we talked to said co-living is actually student housing for grown-ups.
That's fantastic. Yeah, I'm sure that's, I think if you did a survey of all the people who cohabitated with fellow students during college, I think one of their favorite parts was when they didn't have to do that anymore. Right. So I'm curious how people are thinking about it now. Now it's probably more of a must and a need, but is it something that you think that they're like, yeah, I'm okay with it, or begrudgingly, well, I just have to do it?
I think, that's interesting, on their perspective. I think partly, it's an expense issue, and it may be an income and expense issue. And if you're going to live in a city like New York and you can't afford what the market rents are going to be, this is going to be an option. It's just interesting. I guess it's appealing to people that they want their room, but then they're fine with sharing, sharing common areas or sharing kitchen space and that kind of thing with other people. So, though it does seem like this is one of the cohorts that this does appeal to, are graduate students who the traditional student housing historically is underserved. So, some of these new projects that are coming up, it's a blend of graduate students and then young professionals living in these new developments.
Yeah.
So I think the story we did this week points out that the largest community built from the ground up that fits in this category is in Queens. It's called Alta Plus, and it has 422 beds in one project, and it's mostly studio apartments and suites of bedrooms that are all rented out to roommates.
Interesting. So when you say studio apartments, I mean, usually a studio doesn't have a bedroom at all, but then you're saying a suite of bedrooms. So a studio apartment would be just a single person, I would think, and then the suite of bedrooms, is that kind of like are we looking at the Brady Bunch style, where you've got 2 rooms connected by a bathroom and then maybe a general living room, and you've got the same setup on the other side, so maybe they each have their own bedroom, so there's 4 bedrooms and then just 1 living room, 1 kitchen? Is that what we're looking at?
Yeah, I think that's my sense of how the suite would be set up.
Gotcha. Well, as long as you got your own bedroom, I think that's maybe slightly acceptable, but
and I guess, in some cases this is, I mean, in a lot of cities, roommate living is popular already or a necessity depending on your income level. And I guess this is just a way of formalizing it in a different way.
Yeah. Well, as long as I think I'd love to see the floor plans for some of these places, because that's what I would want to know. I got to know, how much space do we actually get here, and how much privacy do you get, and not averse to living with somebody. I've been with my wife for 25 years, so it's worked out so far.
Yeah,
so.
Good model.
Yeah, it's a pretty good model. I don't expect roommates just to get married for that, but whatever. To each their own. Is there anything else in this report that stands out to you?
So there's I guess 2 more interesting points that I found in the story. One is that, so if you're a traditional student housing operator, you're obviously, that's in use for a certain part of the year. Your leases are different because students are not signing 12-month leases. They're signing leases for the school year. So you kind of have this typical, a regular cadence to how your income is coming in, what are the up and down times for your cycle, and you kind of adjust your business model accordingly. Obviously, once you start branching out into a building that has some students and some non-students, you're going to have people on different kinds of leases, and that's going to have some impacts on the financial bottom line. It seems like it could be a little tricky, where you have some units that you're collecting rent for whatever 9 months out of the year, and then others that are 12, and you have these move-in, move-out periods based on the academic calendar. So I think from the financial level, that seems like an interesting challenge for them to wrestle with when, as opposed to like if it's just a pure dedicated student housing project, you just sort of know that that's what you're going to have, as opposed to these blends. The other factor with that is then for the tenants themselves, it seems like in some of these buildings, what they're doing is separating by floor, so that on some floors is where all the student housing would be, and on other floors is where the young professionals would be, to in terms of noise levels, in terms of dealing with that, like
schedule and all that,
scheduling and disruption of like lots of people moving in and out. Like you may not, if you're just, if this is where you live, you don't want to have to deal with these couple of times a year where you have mass move in and move out around the academic calendar. So if they can separate that to another floor, that seems like a way that they're trying to deal with those kind of concerns.
Okay, now wait a second. We got to back up here for a second, because now I just thought of something. So if you've got a suite, right, with, let's say there's 4 bedrooms in this suite, who finds the roommates for this? Because when I was, back in the college days, when we had an apartment and we had roommates, we chose who we lived with, and we say, hey, let's get in a lease together or whatever. It doesn't sound like that's really a possibility for people in this situation. At least it would be a high risk if, you get 3 other people together with you and then 2 of them move out. You're not going to be able to afford half of that rent. Do they choose who lives there in each bedroom?
I think people just apply to live in the building. So you may not necessarily choose who your suite mates are.
That's no bueno, man.
Yeah. So I think that's part of where it fits in the marketplace, because if you do have a group of buddies and you're moving to a city, you can maybe just find a 4-bedroom, a 3-bedroom apartment, whatever you need.
Yeah.
That aligns. But if like you're, a young person relocating to a city, you don't necessarily have an inroad to that, then in New York, it's always a struggle, like for people trying to find those roommates. You end up going on Craigslist or those other, you're kind of just out in the wilderness. So this may be a way of like being more formal. If you trust this operator, or you're familiar with this company because this is where I lived in one of their buildings on a campus. I trust the operator. I know the amenities are going to be good, and I'll just see how I get placed.
Yeah, I that's a lot of trust, man. I got a low gag reflex, and nothing against other types of foods. I eat foods from all over the world, but if somebody brings in kimchi to my apartment, I'm stuck. I have to stay in my bedroom 24 hours a day. Right. Yeah, that's a lot of trust. Wow. Okay. Well,
so maybe that's also like why some of them are studio setups and some of them are suites. So like you kind of, like if you really don't want to have that shared experience, you can get the studio, and maybe the only thing you're sharing are the common areas in the building, as opposed to having like a shared living room that you are sharing with 3 or 4 other people.
Yeah. Yeah. That's, that'll be interesting. We'll see how that all pans out. Now, you had mentioned one of the stories, or I think that the third of this trifecta is about mall landlords, right? Kind of benefiting from retail space sharing.
That's correct. So this is sort of I think a theme that we have talked about and will be a theme in our coverage going ahead. Is the retail sector is facing challenges, has a lot of vacancy, is going through a transformation in terms of omni-channel retail and how that's affecting existing retailers and who's coming in and who's coming out. Mm-hmm. So it seems like one of the ways that people are dealing with that is sharing some of their space. So like maybe, I'm not sure if it's technically a sublease or if it's a slightly different legal arrangement. That's one question I actually had about this when we reported it out. But it basically what it is an existing retailer can then license part of their space out for perhaps a very short amount of time, like up to like a week, or perhaps up to a whole year, to have another retailer sharing their space.
So when somebody gets into a retail building like that, it's usually build a suit, right? They're usually creating that space for them. Specifically, that's part of the contract. But when you're doing a shared development like this, are we talking shared open spaces and they just have to kind of work with the space that's already created? Or will they do, like if they're coming in and they're going to put in a small coffee shop within a larger retail space, that they're going to actually kind of build something within?
I get the sense that it's not like a hard build out kind of situation. It's more like, we're just going to clear some space out within the store for you to operate your sub brand, almost like a kiosk or something in it. So I don't know. Like, I think the hard costs might not be as high as if it was, literally like subdividing the space.
So David, a moment ago, you mentioned that it could be a short-term arrangement, like a week or up to a year. What kind of companies are you seeing, or what kind of businesses do you think are going in there for a short-term, week, 2 weeks, a month, just to have that one space?
I think it's primarily online retailers who are trying to figure out if they should be opening stores. So, I think, and in that case, it could be any of these startups that you're seeing that are primarily at this point, like doing subscriptions, or the model of like where like Quip, think about like the toothbrush company now, where they send you your brush heads on on a regular basis, whatever you select. Right now, I think they're primarily pushing themselves online through on a lot of podcasts.
Gotcha.
Because one of the things that I think is driving this is that when people hear about products like that, but then when they run into a physical location, studies have found that then people are more likely to buy it. So it could be a situation where like, okay, Quip doesn't need most likely to have a store open 365 days a year, but they may want to do a quick pop-up in each market just to so people can see the product and feel it out.
Absolutely.
So that's a way to get exposure. I think the study that from ICSC was that once opening a new physical store in a market results in an average of a 37% increase in overall traffic to the retailer's website.
Oh, wow.
So I could see like that being an example of somebody that may never open a full store, but may want to do these things on a rolling basis around the country just to help boost their sales.
Yeah, or somebody, even seasonal, right? I mean, that'd be the other thing is that you get in there for a seasonal period. You're going to open for the 2 months before Christmas, or you're going to open, around the 4th of July holiday if you've got certain, stuff that you're going to sell for that. I mean, that would make a lot of sense, just to be in there for 1 month or even less.
Right. And that's certainly the way that pop-up shops have historically worked. I think the distinction between this activity and the historical pop-up stores is that a lot of times a pop-up store will be taking a vacant space, taking over a vacant space for a short amount of time. In this case, we're talking about an operating retailer sort of doing the same thing now. Like we're going to turn over some of our space to what would essentially also be like a pop-up retail experience.
Yeah. And I mean, you can't fill a huge space like that all the time. And we had a local Target store that had closed down. They relocated, and that building stayed vacant for probably 6 months. And all of a sudden around springtime, an outdoor store popped up there for, about 5 months, and then they were gone. And then they came back the next year. And so they were there for 6 months, and then they're gone and come back, the next year for a little bit as well. I mean, but that's big items, right? I mean, those are outdoor furniture and things like that. You can fill a huge space, and it's something that's timely, and people are going to be shopping there just because it's new. And look at this outdoor store. I'm going to go in there and check it out, and they'll be able to make that kind of money. But yeah, for smaller retailers, this sounds like a pretty good idea, just to be able to pop in for a little bit, short time, and then out. How much control does the main store, I guess the main owner of the property, have over these smaller shops?
I think they have a lot, because I think basically what this is, it's like Airbnb for retail. So ultimately, the primary tenant, it's still their space. They still have liability, all the other issues. So they probably have a good amount of say over what the pop-up is allowed to do.
Yeah, I mean that well, as long as they've got control, I think it might be actually really beneficial. That's great.
What this potentially does from the retailer on these smaller retailers is that it allows another way to kind of get exposure to doing a physical store that's somewhere in between doing a temporary pop-up store, a full pop-up store for like 6 months or whatever, and not having a store at all. This is I think the other traditional way that maybe people do this is just doing like kiosks inside of a mall. But this, rather than doing the kiosk in a common area, you're doing something that's similar to a kiosk inside of another retailer's operation.
Well, I mean, it works both ways, right? I mean, if the small retailer inside a larger store, they're getting foot traffic, right? They can do all their own marketing. They can do all their own advertising. They can draw people to it, telling them where they're at. But then just the foot traffic of going into the big store, they're going to get exposure that way. And then on the larger retailer side, same thing. When the smaller retailer is doing their marketing and telling people where they're at, people that specifically go there for that small retail space, they have to walk through the big store, and maybe something catches their eye and they see a sale that's going on. And so they're going to get more exposure and more customers through that means.
Yeah, I think that's a really good point. That actually also gives a larger retailer almost a way to event plan their main space by giving, like in addition to whatever way they might be rolling their own merchandise, by having like, we're going to have so-and-so, popping up here for this week or this month.
Yeah.
That's a way to get their core customers to come back to check something else out.
Yeah, absolutely. Absolutely. All right. What is our next story?
On our journey of how spaces are being more flexible or sharing, we had another piece this week on flexible office space. And it's sort of like the latest developments there, because obviously co-working, WeWork, all that stuff's been now around for a number of years. I think it's the success of co-working spaces is what's leading to these kind of experimentations in the other sectors. So this story that we did this week was looking at what's happening in the co-working space. What are some of the new amenities that are being offered as competition heats up for that market?
So kind of like you just stated, this has been around for a while in a way, because you can rent small offices or small groups of offices from a larger building. So a co-op, if you want, or whatever you want to call it, but those are really short term. It sounds to me like this is more of we're going to build this group together, right? And is it more of you can't do this month to month. You've got to do this, it's got to be by the year, how does that work?
Well, I think what's happening is there is a lot of competition now among the co-working operators. There are more options for potential tenants. So yeah, they're trying to lock people in. They're trying to attract people. They're trying to differentiate themselves. I think the first level of co-working was, we're going to offer you a nice space, fast internet, maybe some basic amenities, snacks or other things that are on site. It seems like now we're going next level, because in addition to the historical people like WeWork or Convene or some of these other people that have always specialized in doing co-working spaces, or that have really emerged as the specialists in the past couple of years, other landlords, traditional office landlords, are trying to get in on the action themselves. They may have space in their now they have space in their buildings that they are turning into the co-working space that they're just trying to operate themselves. So like any market, once you have more competition and you're trying to get people to come back and use your space more often, how do you differentiate? So things like now, for WeWork in particular, they have added a gym concept so that so people in addition to like going to the co-working space, we can, can run down and go to their gym too. So it's like on site. They also recently acquired Meetup, which is a social network that facilitates in-person gatherings. So they're trying to make, like a more integrated offering, so people who are using the WeWork space may have some kind of way to tie in using the Meetup app. Other people are doing things like trying to find other uses for the co-working space when it's not being used as co-working space, like turning it into event space or things that can be done on weekends. And then a last thing that some of them are doing, I thought one of the more interesting examples was that in a building in Dallas, this one owned by a traditional office landlord, they added a whiskey lounge as an amenity available both to the people that are in the co-working space and their traditional tenants. Yeah,
that's a great addition for those that want to do some entertaining.
Yeah, entertaining, networking.
Yeah.
But yeah, so that way, because I think there's becoming many more options. I know even in the building we're located in, suddenly there's now a floor that's for co-working, and they added a coffee shop that's basically available to the whole building. Now we can go down and rather than having to run out to go down the street to Starbucks or something, we actually have now a coffee shop that's like just a few floors below us.
Nice. Yeah. And then it's always nice to have a bit more community. You go to work the same time every day, see the same people every day in the elevator, up and down, barely say hi, so on and so forth. And then now you've got a spot where maybe you actually get a chance to have a conversation. That's good. I like that.
Yeah. I don't know. We'll have to see where we end up with co-working, but it seems like it's increasingly taking over the sector.
Yeah, definitely. Well, I mean, it makes sense financially. So, all right. Anything else about this story, or are we moving on to the last?
We can move on to our last item of the week, where we'll finally move out of our sharing stories into a different topic.
All right.
So the last piece that I wanted to touch on was based on what's happening with non-traded REITs, and we had some new data that came out from Robert A. Stanger and Company, who's sort of the authority on tracking non-traded REITs. That found that year to date that sector has raised $2.7 billion, at least through April, which is a little bit more than double what the non-traded REIT sector had raised in the same period in 2018.
Dang, that's huge. Doubled it, more than doubled, like you said. That's huge. So what does that mean? I mean, what does that tell us?
I mean, it's obviously good news for non-traded REITs. Mm-hmm. That industry has had some ups and downs, because since the shares don't trade on open markets, there have been, it doesn't benefit from much happening with the share price. There's always been some concerns about transparency and liquidity, and sometimes you have to own the shares for a certain amount of time. You can't just sell them once you buy them. So in recent years, what the sector has done is made some efforts, partially pushed by new financial regulations, to be more transparent, to have more regular reporting, to also they have increasing options for ways to on some of these REITs to sell the you're not locked in as long when you buy the shares. So I think all those sort of things, all those different steps they've taken to respond to concerns from the marketplace has led to them seeing some increased buy-in from investors.
All right. Anything else we need to know about this story?
I think the other piece of it was that the data that they had put out, again from Stanger, was that the non-listed REITs on a 3-year period with cumulative returns were a little bit above what the publicly traded REITs, at least for that period. So that was another sort of interesting point. But I think for that piece, it's probably people can go visit the site. We have a chart as well with the story, and kind of dig into what some of the numbers they're saying. Yeah,
absolutely. What's the site again for listeners?
NREIonline.com.
Perfect. All right, David, thank you so much. This is a great recap of the week.
All right. Thank you so much for your time and for walking me through the stories. And thanks to our listeners for tuning in.
Yeah, absolutely. And thank you all. Like David said, thank you for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with the new podcast with all those new stories, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. See you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.